All right, so you want to own a zoo, or at the very least, you want to know what actually happens after you wire the money and take ownership. First of all, a modern zoo can cost anywhere from 50 million to 200 million dollars, sometimes even more. That's more than a regional airport. It's more than the GDP of some small nations. But here's the strange part. The company that operates the zoo usually doesn't own it. And more importantly, how does owning a $150 million facility actually generate money? Because in the zoo business, ownership is a completely different business than operation, and it's far riskier than it looks. When people hear about zoos, they imagine cages and animals. But a modern zoo is essentially a floating, self-sustaining industrial city. It consists of thousands of square meters of specialized land, steel and concrete structures designed to withstand decades of wear and tear, and life support systems for hundreds of animal species, all built with an expected operational life of 30, 40, even 50 years. Take a large zoo ordered from a major construction firm like the China State Construction Corporation or Germany's Zoologische Gärten. But the prices are not random. It all depends on the price of land at that moment, the type of animals you want to house, the capacity of the facility you desire to build, and global tourism demand. The ultimate wild card. Zoo prices don't behave like traditional real estate, they behave like volatile stocks. When tourism booms, prices surge. During downturns, they collapse dramatically. For example, during the economic crisis of 2008, some zoos saw their visitors plummet 40% in a single year. Zoos that cost $100 million to build were suddenly in financial distress before they even fully opened to the public, simply because demand had crashed. In the global zoo industry, there are three main players: the zoo builders, the zoo operators, and the zoo owners. And almost always they're completely separate companies. For example, a global operator like Merlin Entertainments, SeaWorld Parks and Entertainment, or Germany's Zoologische Garten manages dozens of facilities. You see their logos on the entrance gates, but they don't own all of those facilities. In fact, many operators prefer to own as few as possible. Many are simply leased, so who holds the deed to that $150 million facility? It might be a family of tourism magnates. Families in Europe control roughly 20% of all private zoos in the world. It is a multi-generational art form of buying low and selling high. It could be a German KG fund where everyday citizens pool their money together to buy a single zoo for tax benefits, or a Japanese leasing company, massive financial conglomerates that buy zoos purely as depreciation assets on their balance sheets, or even a private equity firm operating out of a sleek office in New York or London. These owners don't care about animal conservation in the practical sense. They don't care about the logistics of keeping a lion healthy or educating visitors. They simply rent out their facilities. Owning a zoo is basically a massive high-stakes leasing business. To make your money back, you have to lease it out. There are three main types of management agreements, each with a vastly different risk profile. Number one is the long-term management contract. It is a safe bet. The operator manages the facility for a fixed annual fee over a specific period. For example, $40 million per year for 10 years. The owner provides the facility, maintenance, insurance, and base staff. The operator handles daily operations, marketing, and visitor management. If rates are high when you sign, you lock in strong guaranteed returns. But if the tourism market explodes right after you sign, you're stuck at the old rate. Number two is the bareboat lease. The operator rents only the facility. They handle absolutely everything from hiring staff to buying insurance to maintaining the structures for the owner. This is lower income, but almost zero involvement. Hand over the keys and wait for the monthly check. Then comes number three. That is the revenue sharing partnership model. Zoos are managed trip by trip, event by event. Rates swing wildly based on current events, seasonal demand, or sudden geopolitical crises. This is where owners create generational wealth. When the COVID-19 pandemic hit in 2020, halting global tourism, occupancy rates plummeted. Zoos that usually generated $50 million a year were suddenly in financial trouble. Owners lost billions in just a few months. But the recovery was brutal. By 2023, as tourism normalized, many of those rates had surged by over 70%. How do these owners afford the zoos in the first place? Because almost no one pays in cash. The typical financial structure is 30% equity and 70% bank financing. Banks specializing in tourism provide colossal loans secured by the facility itself. To protect themselves, owners use a legal shield called a special purpose vehicle. If a European magnate owns 50 zoos, they don't own them under one massive corporate umbrella. Instead, they create 50 separate companies often registered in Luxembourg, the Cayman Islands, or Panama. It's one company, one zoo. Why? Because if one zoo has an accident, an animal epidemic, or goes hopelessly bankrupt, the rest of the fleet is safe. But there's a massive problem lurking here. Let's say you borrow $70 million to buy a $100 million zoo. A year later, the market crashes and the resale value drops to 50 million. You're now underwater on your loan. The collateral is worth less than the debt. Bank panics and demands cash. If you can't pay, they seize the fleet. Zoo history is littered with the corpses of over-leveraged companies. Let's assume you manage the debt perfectly. You still face another enemy: regulations. A zoo physically lasts 50 years, but environmental rules are currently turning the industry upside down. The push towards sustainability means sudden mandates for new power systems, retrofitting structures, and massive environmental improvements, costing millions per zoo. Furthermore, what happens if you build a zoo today focused on tropical species only to discover in 10 years that the global standard is local species conservation? Your zoo becomes a stranded asset. It's too expensive to operate, illegal in certain jurisdictions, and impossible to sell. Its $150 million drops to zero. Owners are constantly gambling on regulatory trends, carbon taxes, and geopolitics. Zoo ownership rewards patience and heavily punishes overconfidence. Because of this, zoos are traded just like volatile commodities. A facility bought for $150 million might be worth $180 million in a boom, because buyers want a zoo today, or drop to $90 million in a crash. Some owners don't even intend to operate the zoo for its full lifespan. They speculate: buy low, lease high, sell high. And when a zoo finally reaches the end of its 50-year operational life, it still holds value. It is sold one last time to demolition companies in places like India or Bangladesh. There it is dismantled piece by piece. The owner is paid for the land value and structural materials. Even in death, a large zoo might yield $15 million in recovery value, an absolute final floor to the asset's value. So why does this chaotic system work? For an operator like Merlin Entertainments, owning every facility in their fleet is incredibly capital-intensive and debt-loaded. If global tourism slows down, an operator with 500 owned zoos still has to pay 500 mortgages, even if they're operating with few visitors. Leasing provides flexibility. If demand drops, the operator simply lets their short-term leases expire and hands the zoos back to the owners. The operator stays lean, the owner takes the financial hit. This separation of ownership and operations spreads risk across the global financial system. When an operator goes bankrupt, the zoos don't disappear. The owners simply take them back and release them to a competitor. Companies may die, but the zoo keeps operating. Owning a $150 million zoo isn't just renting facilities. It means managing staggering debt, predicting macroeconomic cycles, betting on environmental regulations, and surviving brutal volatility. But when you multiply that across hundreds of zoos, leveraging debt and reading the tides of global tourism, you begin to understand how modern zoo empires are built. Not through control of animals, but through the relentless calculation of risk. And that, friends, is the real business of the zoo.